Hi, this is Steve All from the All Financial Group, and I wanted to welcome everybody to the March 12th All Financial Group Town Hall. Will not be joining us today. Will had to have eye surgery for a disconnected retina earlier this morning. Everything went well for him. So if you can just pray for his recovery, we would really appreciate that. So it's going to be Mel and I like old days when we come into today. Probably one of Mel's last town halls. So I am going to go ahead and turn over tonight's town hall to Mel Brand.
All right. Thanks, Dave. I appreciate it. As I say, this may be one of the last opportunities I have to speak to you guys on this particular venue. And I just want to make it about a subject that is near and dear to my heart, because as I say, I've been involved in it for more than 30 some odd years. And that is, what do you do with a bad annuity if you happen to have one? And what I mean by that is that there are certain types of annuities we don't recommend under just about any circumstances. And even within the more conservative versions that can protect you from market losses, they're not all created equal. Some of them are very poor performers. Others have been great performers, but due to changes in market or interest rate conditions, they lose their vitality. To me, that's no different than you bought a mutual fund that was performing well, and then it falls on hard times. What do you do with that? Do you just keep it, or do you get rid of it and trade it in for a different one, or a different or stock portfolio? At one point, Transamerican stocks might have been good, or Pan Am stocks might have been good, but not anymore. Things change over time. So one of the things that we do, and we recommend that you do if you have an annuity, is to keep track of its performance and understand that due to changing interest rates. For example, interest rates from 2009 all the way to about 2019 or 20 were very, very low. In the 1, 2, 3% range, and it was a little different when people were issuing an annuity product where the federal interest rate had an effect on what the offer for upside potential was with that product. Well, when interest rates went up in the last few years, that changed what the insurance companies were allowed to do to make an offer to a better rate. So we do a very regular sweep of annuity that have been issued to our clients to see if they are performing up to expectations and to see whether or not they could be replaced with a better option. Now, we have certain criteria that we have to go by. One is we have to make sure that the exchange from product A to product B is in your best interest. If so, not just in performance, but in that you don't lose any money in the transition, that you maintain your potential or improve your potential for growth, and also that you understand what the negatives are. I spent a great deal of time today talking to some people about their annuities that, even within the same company and the same product, are performing differently based on when they were issued, because it is determined by what the interest rates were at the time of issue, what the potential may be within that product. We looked at one today that was issued in 2014, same exact product in 2016. The 2016 product is way outperforming the exact same product issued in 2014 because of timing. So one of those might need to be exchanged for a newer, more up-to-date product, and the other one is just fine, staying right where it's at. So it's not even just saying, hey, this company's bad or that product is bad. It has a lot to do with outside influences on whether or not the product is living up to expectations. So the fix is constantly monitoring the valuation of an existing product and looking to see if it makes sense, if it is in the client's best interest to exchange that old product for a new one. As I say, it has to be in your best interest or we wouldn't even talk about it. Now, you also have to accept the fact that there may be negatives involved in making that exchange. On a couple of the ones I looked at today, we were 4 years into a 10-year period, surrender charge period. And if I exchange that product for a new one, I pick up a new surrender charge period, which may be the same amount of remaining years or more. So is the restriction on access to the money where you can only take your free withdrawal without a penalty, is that worth the extension of that time period to potentially get a better gain or pick up a bonus that would give you more profit? That's a decision you have to make. Are there differences in the fees? A couple of them I looked at today. Not only did we get a substantial gain on moving the product for the client, one client was $27,000 profit by making the move. The internal fee from the old product was 1.5%. The new internal fee is 1.15. And for that 1.15, you pick up a lot of extra enhanced features. So you pay less and get more, plus make a substantial profit for making the move. Now, we did add on a 2 or 3 to 4 years worth of additional surrender charge period. For that particular client, they had plenty of other invested assets, several other annuities. The likelihood of them needing to draw more than their free withdrawal is very, very low. There's a ton of additional features built into the new product that would substantially improve their situation. So in that case, we decided to make the move. On a couple of others I looked at, the exchange really just was basically swapping A for A. There was no real gain in the product. There could be a there could be a enhanced potential for growth, but that's a might or a maybe. It's very hard to quantify that. But the initial exchange really just wasn't worth the time and effort. There was not enough gain to the client to make it viable. My point for those of you that have annuities with us, just know that we are monitoring them on a regular basis and looking to whether it makes sense to exchange them for a better product that would be better for you. For those of you that might be listening to this that are not our clients, one of the things that we offer is something called an Annuity X-Ray, or an examination. If you provide us with a statement and or the name of the product, what we can do is look at its benefits, its performance, its internal cost, and compare that to what's available today. And whether we offered it to you or you bought it from somebody else, in some cases, it is very much to your advantage to exchange that old product for a new one. In a lot of cases, it's not. But even if it's not to your advantage to exchange it, understanding what the rules are for your existing product, because let's face it, a lot of you bought them, you don't have any idea how they work. Nobody bothers to explain them to you, and they just are what they are, or you might have some knowledge, but you don't have an in-depth knowledge. What Steve would do and would look at this product that you have and examine it and look at its internal cost, what your performance has been, what options you have on free withdrawals, what additional benefits you may have, how to use that product to your maximum benefit. That's very, very important. So if we can't make it better, we can at least make your understanding of it better and allow you to have more knowledge on what to do with it. And we're more than happy to do that. And if it's not in your best interest, we would never recommend that you exchange one product for another. It's just part and parcel to the way we do business, but we'd be more than happy to give you a second opinion of your existing annuity if you'd like to see that. So my point today was, what do you do when you have a bad annuity? First of all, do you have a bad one? Do you understand what the other options are, what other options are available to you? And if it is there anything you can do to improve on it or make it a better product for yourself? Or at the very least, understand what your options are with that product to get the most out of it that you can. So that's my presentation for today.
Thank you, Mel. I really appreciate that. I know you've spent a lot of time today when we, looked at some of the products that we had that were underperforming. It could be the exact same product. One client's got an excellent thing with it, and one client, it's all about timing. So thank you very much on that, Mel. So you could be one of those clients that we're getting a hold of. If we've got something, even if we sold it, that we feel that it could be advantageous for you to move, please don't hesitate to call, reach out for myself, Mel, and we can talk more in depth about that situation. Happy to go a little different direction, because nobody's concerned about the market right now. So, let's just kind of pull that little thing off the table. Yeah, we start to look at it, and I know I say it a lot of times. If we can keep the emotions out of our investing, it's the most important thing that we can do. You know, I think that the market got over exuberant after the election. And it was overbought. It was too high. What happens when markets get too high? They start to decline. And I think we're in that same situation right now, where we look at it when markets are starting to be oversold. You know, we do look at it, a lot of people don't realize that corrections, a 10% decline in the market, happen almost every year at one time during that year. It's that common. Now, bear markets, things being down by 20%, that doesn't happen. That's about one every 7 years. And a lot of the bear markets are usually driven by other external factors. Let's look at the external factor in 2000. There was this little thing that most of us can remember called Y2K, and nothing was going to work on January 1st of that year. So the technology, everybody replaced almost everything that had a computer chip in it. And then when the sales in January of the following year weren't very big, people were surprised. How these great big valuations that these companies had, they couldn't support them anymore. Why? They weren't selling anything. Why? Because we all bought it in 1999. So that was a big part of the balloon for what happened to the investment markets in 2000 to 2002. It took a while for that to work its way out. Now let's go back to 07, 09. What was that around? That was around the fact that banks were loaning money to anybody that had a pulse to get a, quote, loan. So we come into that part of the category and the financial collapse. The banking industry was ready to go under. A lot of people say the Fed shouldn't have done anything. In my opinion, if they wouldn't have, a lot of banks would have failed and a lot of us would have got hurt a lot more. You know, that's where the, quote, medicine was not quite as bad as not taking anything. So that was, again, that big decline of over 20%. When have we seen it since then? The pandemic. We had a 30% decline in 20 days. Why? They were going to shut down the world economy. So it put everything in a completely different match. Right now, uncertainty is what's driving the market right now. And a lot of it has been driven by the current president, you know, in the fact that the saber rattling around tariffs, I'm on one day, I'm off the next day. Well, I'm going to do this, so the country retaliates. And then it goes from here. The hardest thing on markets is uncertainty. And that's what this is causing right now. Now, according to the election results, approximately 50% of the people didn't care for the current president anyway. And approximately just a little more than 50% voted him into office. Well, I've heard enough news to the point where some of the people that voted him into office are trying to question some of the things that are being done. And I'm going to say right now, be careful, because most of us have biased around this. We're either for the current president or against the current president. And I hate to say it, if you Google search something, it's going to follow your biases. If I'm against, I'm going to find articles that are against. And if I'm for, I'm going to find articles that are for. And I think that's the reason why we're here. To bring people in. Had a review earlier today. Client comes in. I'm not sure what's going on. Where's everything at? Markets are just getting killed. What do I do, Steve? So we did a quick analysis. Yeah, the quote, NASDAQ is down 10% so far this year. The S&P 500 is down almost 5%. But we looked at the Market Guard 60 target models, still slightly positive. Why is that? Non-emotional, mathematical methodologies that are put into the models. It's not market timing, folks. He's not going to buy the day before it goes down and then purchase it back on the lowest day. The target models can trade once per month or when necessary. That the trade on March the 6th did make the portfolios a lot more conservative. So a lot of the things that people are asking us to look at, should we be as aggressive right now or should we be pulled back? That depends on the client. Our more conservative clients that are in the targets, that's what it's doing for you. Our more aggressive clients that are in the technology funds, the stock portfolios, they're going to have a little bit more up and down right now. But that was a risk that we were willing to look at. And as an advisor, I would not allow any of my clients to put all of their money in one aggressive strategy. It would not make sense. So that's the thing that we look at with the different areas. Where are you at? Where's your comfort level? People like days like today when the market bounces back a little bit. People hate days like Monday when it just falls. So those are the things that we have to look at. And that's what we get to look at on a regular basis. It's like I said, personally, I believe the markets were overbought and way too high. What happens? We have corrections to take that out of the deal. What's what we've had? We've had a correction. We're putting the market back in line. And now a lot of people look at us today and say, the markets are now oversold. So we go back and forth with those things. And that's the idea of where we want to look at. If the emotions are getting the best of you, don't hesitate to give us a call. If you're not a client out there and your advisor hides under the desk when markets like this hit and he won't talk to you, please give us a call. Let's sit down and figure out where your risk tolerances are really at and how comfortable you are. And then look at that. If I've got somebody that the market being down one day, you feel it in your bones and you have a bad day, you might be taking a little bit more risk than you should be taking. Let's sit down and make sure that your portfolios are adjusted for your risk tolerance. Because everybody loves it when the markets go up. But we get a little more nervous when the markets go down. And that's absolutely normal. I wish we could take the emotions out of investing. I wish I could get my emotions out of investing. But see, I do the exact same thing I'm asking you to do. How do I want to be invested? And allow the professionals that actually make the trades to do that. Because I don't make the trades. I talk to you, the clients. Figure out where your risk tolerance is. And then pick the models that I think would be best for you. And Mel mentioned it earlier. Part of the portfolio can't go down due to market volatility. So it takes the risk completely off the table. And I think we forget about that on the down days. So it's a good balanced portfolio that I think is the most important thing that people should be looking for. And we're here if you get uncomfortable. So I'm going to say thanks everybody for listening to this today. Markets, up, down, stay the same. It's going to do one of those three things. And the good thing about it is we don't get a lot of calls because I think most of the clients realize that that's where you're at. We love it when it's up. We hate it when it's down. But I'll also say one more time, if it's making you uncomfortable, please give me a call. Let's talk about it and build a portfolio that you're more comfortable with. A reminder, Friday the 14th, we're having a going away party for Mel here at the office. Please call the office if you're planning on coming. We would really appreciate that. We do have an event at the Twisted Tree on the 25th and the 27th of this month. It's filling up fast. If you got a guest and you'd love to bring that guest to it, please give us a call. Our dinner presentations have been so overly applied for. We're actually doing some overflow things in here in the office, where we're bringing the people in and say, would you be willing to come into the office and sit down and listen to us talk? So if you know anybody that would fit in that category in the event that the dinner event was sold out, please give Chris a call at the office. If you're not a client, you do have to qualify to come to one of the events, and we'd love to see you here. Business continues to grow even when markets go down, and it's because of the referrals of family and friends. And I just want to thank everybody for being a part of the All Financial Group family.